Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we're working on the theory for Chapter 11, which is on the statement of cash flows. And it just dawned on me that I actually didn't, in the introduction, I didn't say, hey, this, if you've had the subject, math for business and finance, or you've had math applications with us at Penn Foster, okay, there was one whole chapter in that textbook that covered the statement of cash flows. So this, if you've had those subjects, you should be familiar with this already, okay? It just didn't dawn on me until now that, yeah, you had that. So go back to those particular subjects, and if you go under the student community where, on the section just above this here financial accounting section in the business group, there's, go back to that chapter and you'll see theory videos and homework problems dealing with the statement of cash flows, because as I seem to recall, there was one whole chapter in that subject that dealt strictly with the statement of cash flows. All right. So with that said, now we're going to look at financing activities. All right. And financing activities, operating activities are revenues less expenses, the operation of the business, selling the product or performing the service. Investing is just the way you think about what am I investing in. And financing, I have a tendency to think of, well, in the back of my head, the way I keep it in track is things like finance charges, interest charges, that type of thing. Okay. So, it's a matter of how we deal with the being able to, and it's hard to say, you're not supposed to use the same, try to define something by using the same word. Um, but in financing activities, it's what we finance, okay, in the business. So, these are the four things that are most commonly used, all right? So we're going to look at the increase or decrease in our long-term liabilities, whereas in the investing activities, we have a tendency to invest in long-term assets, okay, because we're buying those long-term assets, okay? But when we invest in long-term liabilities, liabilities are something that we owe, okay? And so therefore we're financing, it's being financed, whatever we owe is being financed by that particular company, business, or whatever have you. So we have to look at the increase or decrease in the long term of what we owe as a financing activity. Um, So that's the first one. All right, we look at our long-term liabilities and we say, okay, have they increased or decreased? And that's on from our balance sheet. Then we look at plus the increase in common and preferred stock accounts when common or preferred stock is issued for cash from the balance sheet. Right. So when we're selling common and preferred stock, right, and we're doing it for cash, not as a stock dividend, right, we have to add in that increase for the sale of the common and preferred stock. And of course, when we buy back the common and preferred stock, we have treasury stock. So we're going to subtract out the increase in our treasury stock. All right. And that can be found from the balance sheet itself also. And then we have minus the decrease in retained earnings due to paying cash dividends. Okay, so we're going to subtract out the decrease in the retained earnings due to paying out cash dividends. So, and that comes from the balance sheet. So what you're looking at here is, and now let me just jump back up here to give you a little bit more of an idea. Okay, here's 2013, here's 2014. All right. Notice that here on this balance sheet, we don't have any, no, let me back up just one more quick second. Here we have our income statement and our balance sheet. On our income statement, we're going to be primarily looking at the operating activities. right? And we're going to be adjusting our net income, based upon those criteria, all right, so that we can get to the cash position. So we'll be taking out things like our depreciation expense. But when we do investing activities, we're coming over here to the balance sheet and we're looking kind of like at our long-term assets. Okay, and in this case here, we don't have any long-term assets. Or they're calling it fixed assets net. It's possible that that's our long-term assets. So, we have a difference here of $70,000. We might have to take into consideration that $70,000 as financing activities. I'm sorry, investing activities. And as far as financing activities is concerned, we have long-term notes payable. Well, that increased, right, from one year to the next. So we're talking about here about $49,000 difference in the increase in our long-term notes payable. So we're going to have to consider that as part of our financing activities. And then we also have to look at our common stock, right? That increased. And then we have treasury stock. There was a change in our treasury stock. And then we have to look at the net effect on our retained earnings. So you can see how we're kind of like going down through and we're pulling things out and we're making adjustments to these financial statements, and that's all going to be reported on our statement of cash flows. You're doing all of this here math right here, okay? You're looking at the different things and you're doing the math and you're putting it on your statement of cash flows, okay? Now, and I know that this was supposed to just be the financing activities video, okay? And so we have these here things to look at, but I'm trying to, bridge over to the next issue, which is formatting, okay? All right, so if we started out here with these financial statements, okay, and we go down through our different sections on the financial statements, our operating, investing, and financing activities, right? We can look at the more common things that affect our operating activities and what we need to do with them. We can look at our more common things that affect our investing activities and what we need to do with them. We can look at the more common things that affect our financing activities and what we do with them. And what we end up doing is we end up putting it on our statement of cash flows. But there's two different methods. There's an indirect method and a direct method for reporting this. But notice, and we'll get into that in the next video, but notice that there's an operating section here in the statement of cash flows for the indirect method. There's an investing activities, so operating, investing, and financing. Over here in the direct method, operating, investing, and financing. All right, and then that gives you your net increase or decrease in your cash during the year. Okay, net increase, decrease in the cash during the year. So these are the three sections, okay? And the bottom line is whether your cash goes up or your cash goes down, and how you're accounting for it. All right. So now, I'm going to stop the video here, and I'll move on to the next video and talking about, these two different formats and what to expect from them. Okay. This slide here. Never mind. It's good enough the way it is right now, okay? So I'll see you in the next video for formats, and you'll see how all of this ties together, all right?